Have you ever heard you want all the market upside and no downside? Let's really look into what people are talking about with that. Hey, it's Eric with Jazz Wealth Managers. Let's talk a little bit about all the market upside, no downside. Man, that sounds good. Sounds almost too good to be true, doesn't it? So that's what I want to talk about. It's actually referring to a fixed annuity. There are variable annuities, fixed annuities. I'm just going to tell you something. These things get crazy confusing. I actually started in the financial industry, and when I did, I worked for a company that sold annuities and life insurance and all this stuff. And there was a big incentive for selling. That's one of the biggest issues with this. Not trying to take a dig at anybody that sells these things, but the fact is that companies, these massive insurance companies, are always profiting off of others and their fear. That's what insurance ends up being. Yes, it's nice if something happens and the insurance gets paid out, but if you were to take a little bit more risk with your portfolio and be comfortable with it, is it worth actually trying to do this annuity instead? So there's a lot of talk right this second with all the market volatility. People are coming out of the woodworks and telling you crazy things just like, hey, let me get you into something that you get all the market upside and no downside. Nobody wants to see their money go down. Everybody wants to see it go up. So, I mean, the saying makes sense, but unfortunately, it's not all factual. So let me break this down a bit for you. I'll talk a little bit on fixed annuities today because variable annuities also are another thing that's out there that oftentimes gets sold and are trying to take a little risk off the table, but in reality may not be the best thing for your dough. But with the fixed annuity, the thing about this is that with these and the way they work is you're actually giving up a little bit of your return so that the insurance company gives you some kind of guarantee, such as, I'm not going to let your money go down. That's the kind of things that happen with a fixed annuity. They'll give you either a guaranteed rate. This could be just an interest rate that comes into play, or they could say, hey, you know what? Let's actually put you in the stock market and play it against the stock market. Now, you're not actually in there, but what they're going to give you is something called a cap rate. So check this out, because I was actually looking at one of these policies. This is just a random website that I'd pulled up here that talked about it. So sorry for all the ads there with this, but the idea with this one is it is Pacific Life Index Foundation 5. Now, I'm not sitting here trying to go into all the nitty-gritty details because honestly, there's some of this that you don't know unless you contact the company. But there's all kinds of riders, there's all kinds of things. What I wanted to find was a pretty cut and dry policy, and that's what I'm finding here with this one. The way it works, you got to put at least $25,000 in. It doesn't show right here, but it's a 7.25% cap. So what a cap is when you're looking at the stock market, if the stock market goes up 10%, the cap is the most they're going to give you. So they'll give you 7.25%. That's the way that works. And that's for if you're getting a fixed annuity that is based on the market returns. So that's what we're looking at with this. As far as everything else goes, there's a lot that comes into play. It's an index annuity is what it's often called. Surrender charges. Surrender charges are a big one when it comes to any kind of annuity. You have to realize that oftentimes these companies are going to sell it and they're going to lock your money up. The reason they're locking your money up is because they know if they're going to give you a guarantee, they're going to have to invest for the long term to make sure that they're making money on you. They're running everything against, basic averages in the stock market to say, okay, you give me this money for 5 years on average, we're going to guarantee your money will never go down. We're going to cap it at 7.25. They're hoping to always make more off of that because not only is the insurance company now taking a risk on things, now they're also paying out an advisor to sell this policy. So there's a lot that comes into play. They want to make sure they're making money off of you when they do these. With this, as far as it goes, the surrender period oftentimes is going to be for the life of the contract. If it's a 5-year annuity, then that's what that looks at. You can take out 10% per year off of these, but you can't take out the whole 100% or you're going to have a huge penalty. The penalty continues to go down as you get closer to the surrender or the end of the contract is often how it works. So looking here again at this, this one's going to benchmark based on the S&P 500. So they have different types of index annuities that are out there. Annual point-to-point or performance triggered. So what this means is basically if an annual point-to-point, what you're looking at is, if the S&P 500 did 7.25%, then you get 7.25. If the S&P 500 did 5%, you get 5%. If the S&P did negative 10, the nice thing is the annuity won't go down. That's what they're oftentimes sold on. You have the cap rate there, or declared interest rate. Declared interest rates are more of along the lines of a fixed annuity that is just with a guaranteed rate. The cap rate is if you are putting this against like the S&P 500. So now let's get into the actual research of this and what I did and what I broke out. Now, I do want to give you one thing that I noticed on this. I'm looking at a great period in the stock market for sure when I'm comparing this. There are times that I could look at things where I could say, you know what, I could spin it any way with the numbers, and that's what oftentimes the annuity people do. So I'm not trying to spin anything. I'm trying to just give you the facts here. If you look from 2000 to 2010, basically the market as a whole was a horrible market because you incorporated in the dot-com crash. You also incorporated in the global market crisis of 2008. All of those combined, if you were in a fixed annuity, you might feel a little bit better about your dough. But how can we combat that, and how do we do that as fiduciaries without selling products, is we could talk about, if you're wanting to go super conservative, you could have a lot of cash in a portfolio. So let's just say, and what I did with this is I actually modeled it as though you were 70% in the stock market and 30% in complete cash, nothing else. So the idea there is what people do when they sell the annuity is they're going to tell you, all right, well, this is the bucket of money that's going to be over here to pull from when the market does go down. Why do I know this lingo? Because I worked in that, remember? And I got out of it. I hated it. It wasn't for me. I wanted to work in your best interest. That's what a fiduciary does. And so the bucket idea of pulling from it when the money goes down, it works if you're not in a surrender charge period. But if you are, you're locking your money up. You can only get 10% of that money that is in that account. What if you want to go do something? You may not want just 10%. You may need more than that. You can't do it. So you got to remember you're giving up a lot of liquidity for this as well. But just to break this down, what I did was I looked at it as though if we are actually incorporating in 70% in the stock market, 30% in complete cash, nothing else. I also put a 1% management fee. To be honest with you, depending on where you're at with us, that fee may actually be a little high. We tried to shoot lower than the average industry average, which is generally 1%. Sometimes the management fee could be even higher. I just wanted to model that to give you a snapshot. So if we're looking here at a 70-30, this is the returns for the past 10 years as of August 23rd of 2022. So looking at the average returns there, this is what we have to take into consideration. So if you're looking at this and you look at the total return, if you combine everything through those years and the down years as well, after those 10 years, your money would be up 100.9%. So if that's the case, you put $100,000 into this account and you rode that, what you would have is $200,900. That's where this is going to end up. Now, yes, you are taking a little bit more risk because you are putting the money in the markets, but you also remember have that 30% cash. That's where we have to look at in the down years, maybe using some of that cash if that's the case. The up years, you want to make sure you're capturing upside. Now, what would happen if you put it in that same annuity for those 10 years? Because it's a 5-year annuity, but oftentimes what people do is they say, you know what, I'm going to go another 5 years with this. So let's just look at 10 years. So if we're looking at 10 years here with this, what I looked at was actually taking everything, and you look right here at the returns. I actually said, okay, this was 8.32%. Well, that annuity only pays 7.25%. You get again 7.25%. This one you get 6.82%. This one you're not going to lose any money. Yeah, there's nothing there. As far as everything else goes, 5.58%. That's what you're going to get. 7.25%. So you get what I'm saying here, all the way down to year to date where we're at. Because the fact is that we haven't finished out the year, so we're looking at from back in August of 2012 when this started. So if we did just that, what does your money actually come to if you did that fixed annuity? Well, right here, you would make $55,900, so it would be $155,900. Now, for some people that are completely conservative, that just are scared of the markets, maybe that feels really good and you're okay with that. That's fine. But for a lot of people in retirement years, you're pulling too much off the table. You haven't done a financial plan. You don't really know even how much risk you need to take. That's the kind of stuff that we like to look at with our software, with our planning, with Nest Egg. to be able to make sure that we're accounting for the amount of risk you need to take. And maybe your scenario is we pull back a little bit more. Maybe we have more cash in a portfolio. That's your comfort level. We're able to customize that here at Jazz. But just looking at this just gives you a snapshot of the differences there. And if you think it's really worth it, I'd say, you're going to miss out on, what's that, $45,000 by just trying to lock your money up versus having everything liquid. Thanks for watching. If you want to watch more FinTips videos, click here. Be sure to like and subscribe also.